In this summary video, we'll briefly cover the following subjects. What are equities? What are the characteristics? The pricing? How does the stock market work? And what is important and why is the stock market needed? For more information on this, please review your Webb and Bramah core textbook. This is chapter 6, which has 30 pages that covers all the topics in this summary video in more detail. So, what is equity? Ultimately, it is the ownership of a company. If a company wants to raise finance, it has a choice of issuing debt, whether that be a bond or a loan from the bank, or alternatively for longer term finance, the company can sell its ownership. Essentially, you have a piece of paper saying you own part of the company. Companies can choose whether they want to sell the full ownership, in other words, go fully listed. Typically when this happens, the company will keep some of the shares themselves, or they'll be kept with the original owners or the management of the organisation. But the rest of the shares, the rest of the ownership is sold to the public. And this is typically done by a market maker, so they enlist an investment bank who will buy all their ownership and then they will sell the shares via the stock market. Shareholders have a right to the profit of the business. So if the company is profitable, the shareholders should have a claim of that profitability via the form of dividend income. If a company later on wants to go private again, they must buy all the shares back. Typically, the shares don't have an end date. It's not that often that companies do buy back the ownership. There was an example recently of Elon Musk at Tesla where he tweeted that he was going to bring the company private again, and that significantly altered the share price. It was later found out that this tweet was market abuse, that he'd used his power as the owner to manipulate the price, given false information, and subsequently punished. There are broadly two types of shares. There's ordinary, or common stock in the US, and preference shares. Both are legal owners of the firm. The only difference between them is preference shareholders tend to be given a fixed dividend, and you'll get their fixed dividend ahead of ordinary shareholders. So if the profitability of the organisation is not that high, then preference shareholders will be paid for dividend, but ordinary shareholders may not. This means at an annual general meeting, however, the preference shareholders tend not to get a vote in any sort of decision, whether that could be a new CEO or remuneration for the board. Ordinary shareholders always get to vote. Preference shareholders only vote if they've not received their dividend for 4 years. So, comparing these to bonds, shareholders are at the bottom of the priority order in the case of bankruptcy. Bondholders would get paid back first, then whatever's left would be at the shareholders at the bottom. Shares tend to be more volatile when it comes to capital gains and appreciation. Bondholders always receive that fixed income, subject to credit risk, of the coupon payment, but dividends are not guaranteed to shareholders. Shareholders do get to vote at the AGM, but bondholders do not. When you study corporate finance to the organisation, there's pros and cons depending on how you want your capital structure to look like. For instance, bonds could have tax advantages offsetting the interest coupon payments against tax. So when you study corporate finance, it goes into a bit more detail. But this module focuses on the benefits and the benefits and limitations to the shareholders or bondholders, not to the organisation. So, just to recap preference shareholders, they do kind of have characteristics like debt, like a bondholder, and they don't carry any voting rights. Similar to an income investor, the reason why you might have this is for the income. You do expect the dividend to be paid, and you could also potentially benefit from more capital gains than you would from bonds. So they're very similar to bonds, but remember, they're ownership, not debt. So what happens when an organisation wants to issue more shares? They have a number of ways to do this. The simpler way is to go to its current shareholders for a rights issue, and it asks their existing shareholders whether they want to buy a new share relative to the proportion of shares they own. And that means that you would not gain any additional ownership relative to other people. Your just ownership would grow in the size like other ownership would. Typically, they would offer this new share at a discount from the current market rate to entice current shareholders to do this. And here's an example to see how it affects kind of the average cost of your shares. A bonus issue, also known as a scrip issue, is where a company will just increase the number of shares out there by giving each shareholder, current shareholder, an extra share or a certain proportion relative to how much they already have. Now you think, why would they do this? This just helps dilute the share, so there's more shares out there, but it'll bring down the cost of the average share. So this can help with price volatility. The more shares there are, more ownership, therefore the larger the supply, which can counteract volatility if demand increases. A stock split is similar. So a stock split also reduces volatility, and what this does is it decides to split the stock, split the share from 1 to a certain proportion. So this example is 2 shares for 1. An example of this mathematically would be if 1 share was £1, a 2-for-1 stock split would lead to 2 shares of 50p. So there'd be twice as many shares out there, but the price would be cut in half. But the investor would end up having the same amount. Again, this reduces volatility. In recent history, the likes of Apple did a 7-for-1 stock split to really lower their price. And their reason was to try and allow the public to buy their shares because they were too high and it could only be bought by institutional investors. There are many ways of pricing equity. You're highly recommended to review Chapter 6 of your core textbook to get more understanding. But essentially, the price of a share is the present value of all future cash flows. And then cash flows are dividend payments and capital gains. Now, of course, the tricky bit here is trying to work out what the future cash flow of dividends is, because there might not be any. But then there's also the capital gain aspect. How can you predict what the future price is going to be? And then you present value them cash flows back to today at a certain discount factor. So a very, very subjective way of pricing equities. But the idea behind the market is when everyone does this, then the equilibrium of buy and sell will get to the equilibrium point being the price. When it comes to dividends, there's a number of dividend discount models you can use. There's the zero growth, which just assumes dividends are constant, so the dividend stays the same. There's constant growth, where you expect the dividend to slightly grow over time as the business does and profitability grows. There's also one where you'd use for companies that have volatile dividend payments, where you have non-consistent growth, so you try and smooth out the volatility of how often dividends are paid. But again, these are all very subjective methods. Here's an example of looking at Apple on Bloomberg. What you'll notice is one thing called the PE ratio. Now this is the price of the share divided by the amount of profit per share. And there's also the dividend yield. So these are another way of looking at it, and this is the dividend per share divided by the share price. So one's more a measurement of profitability share, PE, and then dividend is also profitability of the share in the form of payouts, but it really does ignore capital appreciation. So the formula for the PE ratio is worth remembering from a mathematical and exam point of view. The PE ratio is the market price per share divided by the EPS, earnings per share. Earnings per share is calculated a different formula, which is your net income minus your dividends divided by the number of shares. So net income being the company's net income minus dividends, and divide that by the number of shares out there. So to summarize, the PE ratio tells us how much the investors are willing to pay for a pound of their earnings. So if the PE is 10, that suggests the investor in the stock is willing to pay £10 for every £1 earned from the company generated. Now, you could ask, what is better, a high or low number? Now really this interpretation needs to be compared with something. Typically for PE ratios, we would compare the PE ratio of a company with its sector average to kind of compare the willingness of what shareholders are willing to spend for the earning within that sector. So it's really a comparative analysis is the best to interpret the PE ratio. Here is just a mathematical example. So in the exam context, it might be worth remembering these two formulas, because then you can work out the expected market value for the share when given all the other information. So, the equity market. You do have your primary market and your secondary market. Most of you will be familiar with the secondary market. This is where shares are bought and traded on the likes of the London Stock Exchange or the New York Stock Exchange. But the primary market is what's known as the IPO, the initial public offering. This is where a company decides to go public and sell its ownership. So as I noted before, typically an organisation will announce it, then a number of market makers will tender to underwrite this listing. The company will do its own evaluation. It will get externals to do its own evaluation and kind of set a price or a guidance for what the price should start at. And then what we see on the day of initial public offering is the price the price should correct, whether that be positive or negative correction in what the market believe the company is worth. And this has been in the news quite recently when you talk about the likes of unicorn companies, which are your big American tech firms that technically haven't made any profit yet, but they're listing for large sums of money, and the prices either jump up on listing because of the excitement, but then kind of correct and fall back later on. The reason why potentially these shares increase in value is because of the idea rather than the fundamentals of the company. So this is where the likes of market value severely differ from book value. Because some companies, unicorn companies, generally are not making any profit yet, but they have the potential to in the future. And how do you value a company that doesn't make any money? Within the secondary market, there is known as two types of system. You have your order-driven system, which is more price, and then you have your auctioneer system, which is more about quantity. And the London Stock Exchange has both, and we'll go through these shortly. So, before we get there, what is a stock market? Well, it is just a marketplace, and this is where companies go to raise finance, and where people go to trade on the secondary market. Typically, these are all done PCs now, and most don't have a trading floor, but the New York Stock Exchange does still have what's known as an open cry face-to-face trade trading floor. But most around the world is really a kind of computer. The reason for a stock exchange is to have a level playing field effectively. You have the stock exchange whose job is to ensure that everyone's abiding by the same rules. There's an efficient price in place where transactions can be carried out relatively cheaply by economies of scale, and that everybody has access to the same information at the same time. If the stock market's well run, then it will allow firms to have access to funds, liquidity, allow them to grow. Goes back to lecture 1 when we talk about allocating resources efficiently. This is where companies can raise finance from people who have excess capital. Most stock exchanges obviously do their security checks on companies to make sure they're credible before listing, but also they'll have to check out individuals to ensure there's lower the likelihood for fraud. But also this is the job of the regulators in that country. If you're listed on the stock exchange, then it gives you have to abide by certain rules to make yourself very public, very open. Everything needs to be disclosed to the stock exchange before it's declared to the public. Typically the news from an organisation goes straight to the stock exchange, who then disseminate that information to allow participants to correct the price accordingly. And other things like mergers and acquisitions, this tends to be involved when companies buy the full shares of other organisations, and they must have a good relationship with the stock exchange in order to do this. Have a look at the London Stock Exchange website to get an idea of its history, but typically, back in the day, it was just a coffee shop. It was a place where you'd meet and you'd do a deal over a cup of coffee, and ever since that, it's kind of grown and grown, and now it's just a computer somewhere in the circle of the M25. But the London Stock Exchange doesn't just do shares. It does your gilts, which are your bonds, it does corporate bonds, it's got the euro market. So you can see the scale of the securities traded here in the London Stock Exchange. They also have something known as the AIM market, which is a market where smaller organisations can raise finance as well. To raise finance on the London Stock Exchange, there's very stringent rules, kind of organisation size, costs, and it can be very expensive to just create ownership following these rules. So the AIM market was brought in to have less stringent rules, less costs, and allows younger companies a chance to get equity and grow. And some companies do successfully start on the AIM market, then grow to the full listing. So it's kind of a stepping stone as well. But it's kind of seen as the alternative investment market, but it's really the younger companies trying to get access to equity and hopefully grow by the expertise of the stock market and by access to equity. So London Stock Exchange has plenty of rules, kind of supervises, make sure there's fairness, efficiency. It authorises the market makers who tend to buy the shares from the organisation before posting in this exchange. It also authorises the brokers who the general public tend to deal with. Typically, a broker can also be a market maker or subsidiary of a market maker. It assists via its computer system for price discovery, i.e. stock market efficiency. It also clears and settles the transactions, and it reports to the regulator. But interestingly, what people don't know the stock market for is it's actually the people that disseminate the information, the news. The London Stock Exchange gets informed first, then that's provided to the likes of Thomson Reuters and Bloomberg, and it's disseminated that way. This is to avoid insider trading or an unfair advantage on other people getting the information before the London Stock Exchange and can manipulate the price. Within the market, you have the likes of lenders and borrowers. So we've covered that a lot in this module. Specifically, when it comes to the equity markets, we have the arbitrageurs, your speculators, and your hedgers, and we'll just go through these now. The arbitrageurs are the ones that kind of spot price anomalies across different markets. So they try to exploit stock market efficiency, and by doing this, they'll bring the prices from one market to another closer to one another to ensure that these price discrepancies do not exist. So if they do notice a price discrepancy in different markets, whether that be via currency exposure or just stock market efficiency being weak, they will buy in one and sell simultaneously in the other, and that will make them profit. But what that will do is manipulate supply and demand in both markets to bring the price back together so each market has the same. Typically, nowadays, this would be done by algorithm, high frequency trading. Your speculators, or your investors, who generally are doing an educated gamble, we'll say. So they can either do long-term investing or short-term trading. But speculators will typically buy assets and hold them in the expectation that their capital appreciation is positive and they'll receive dividend income. So this is educated gambling effectively for a level of risk. And your hedgers, these are individuals who may back both ways. So for someone that wants to hold ownership and receive just dividend income, they might buy and sell similar assets or negatively correlated assets. So if one share price goes up, the other goes down, hedgers will kind of break even in the middle, but they'll still receive the dividend payments. So hedging is a strategy of minimizing your risk to try and benefit from dividend income. So let's go back to these two systems of the stock exchange. Your quote driven and your order driven. So your quote driven is posted on the SAAQ system, which is a link to all brokers. So typically the market maker who owns all the shares will enter the bid and offer price to the stock exchange. And if it's a number of market makers that will enter the bid and offer prices, then the stock exchange job is to work out what's the best offer and what's the best bid price, and then pass that to the broker, who will deal with the shareholders. Please note in this transaction, however, the brokers are just a middle organisation. They don't own the shares, they just pass shares from one to another, and they don't have capital exposure to the shares. They're just the people that are in between stock market and the market maker. This is what a typical screen will look like. So the yellow line gives you the best bid and the best offer price, and this is from the list of the different market makers that will provide the bid and offers. And then typically what the marketplace will do is go with the best bid and the best offer, and if other market makers would have to alter their price to get towards this, otherwise no one would trade with them. This is a textbook example, but this is what it really looks like. So on the London Stock Exchange system, the names appear who are the market maker with the best price. So in this case, for the bid price, you'd go to this market maker, but for the offer price, you'd go to this market maker, which will force every other market maker towards these prices. Following this, and criticisms of this technique, the criticisms are that it sometimes makes the market makers alter their price to get in line with the market price, but if collusion takes place between the market makers to artificially change these prices, that this system would allow organizations to do this. So there was induction of the order-driven system sets. So this doesn't really act on price information, it's more about kind of quantity. And this is where market makers or brokers put in their orders and kind of supply and demand below the price. So if more people are wanting to buy, that'll push the price up. More people want to sell, it pushes the price down. And typically, this again, textbook example, giving you a list of what the screen looks like, with the yellow bar being kind of the best prices for the given volume. But this is done from a company point of view, so this screen's specific to a company. And what you'll see here is what it really looks like, and it'll give you a list of all the different order sizes and all the order for all the selling prices. And what it will do is it will try and match individuals, or try and match quantity between buying and sell to execute the trade at that appropriate price. Following the quotation and the purchase stage, there is what's known as T+2. The CREST system is the system that kind of settles transactions and makes a electronic registration of who's got the shares. And the CREST system takes 2 days to settle. So when a trade is being actioned, then you'll have physical ownership in 2 days' time, but you'll go note it down when you made the transaction at what price. But with shares, it's T+2. And this was introduced in 2015. Before that, it was T+3. But today, it's now T+2. Ultimately, why this was introduced was to logistically speed things up. And the London Stock Exchange has its own clearinghouse, which is kind of the store for all the shares. If we look at the market, in the market we have a stock market index. You've probably seen it as the FTSE 100, the FTSE 250, but essentially this is just a portfolio of all the shares in an index number. So the index is not a price, it's a number, and this number really goes up or down depending on the overall prices of the shares within that indices. Here is a print screen prior to COVID-19 impact, where you can see the quite significantly high values of certain exchanges. And this is the World Equity Index, WEI, on Bloomberg. If you look at the security description, it will tell you what the index started as. It started as 100 at some point. In this print screen, you can see it was up at 7,317. However, with the market correction of March 2022, the FTSE dropped towards 5,000. So that's nearly 2,500. Half the index value wiped out in the space of a couple of days. And going back to the likes of the PE ratio, you can have a look to see what the average PE ratio is for the stock market. So you can compare individual companies with that. Now the London Stock Exchange, actually at the minute, the FTSE 100 has 101 companies on. In order for a company to get relegated to the FTSE 250, it's based on market capitalization, which is effectively the number of shares per company times the share price. Is its market capitalization, i.e. how much the organisation is worth. To drop out of the FTSE 100, you have to actually drop down to the 111th position in terms of market capitalization at the time the index is re-evaluated. And this typically happens 4 times a year on set dates. So why you have to go down to 111th is because it allows for volatility. Because the companies, we'll see in the relegation zone, their market capitalization could be more volatile around the period where it's going to get the list's going to get re-evaluated. So it accounts for volatility during this time. Thank you for watching this summary video. As I've noted, you're highly recommended to read Chapter 6 of Web and Brahma, and look out for the multiple choice questions that I may post online or are accessible via the Teach and Learn. Thank you for watching this video.